So I think there are, every industry has a few things where you might be misled by just looking at the numbers in a very kind of quick and simple way. So I will just try to pick a few industries and give you a few examples where over time I learned really to look at some of the pitfalls. There might still be more out there, but I think I'm just growing my experience and I'm increasingly getting wary of the risks and dangers that you might not see if you take just a first look. So let's talk about banks. A bank, you might look at just equity cushion and earnings ratios and so on, but I think one important thing to look at is growth or the book value per share and how this has evolved. So if you have a bank that is only growing because they issue new shares every year, well, the equity might go up and it might all look great, but this dilution might have a reason. So I think there was Commerzbank, the German bank. They were also typical German bank, extremely levered, and they posted positive earnings. Everything looked great, but if you looked at book value per share, it didn't move for 10 years. And I think this is it's a red flag, it's a warning signal. Because we all know especially in banking insurance, if you keep growing your book, you can outrun the losses. If you underwrite credit or insurance policies with at a loss, it will take a long time for this loss to actually show up. And as long as you keep growing, it's fine. But there are ways that you can, I think, identify those pitfalls. Another risk that I see, it's a very similar risk, is in auto companies. I think if you buy auto companies today, you don't buy just a car maker, you actually buy a bank. Let's take a look at BMW. BMW has its own bank, and most of the cars being sold today are sold as leased cars. And then BMW actually keeps the leasing risks on its balance sheet. And if you think about it, depending on how you value the residual value, you can hide losses for long periods, maybe up to 5-10 years. And it's the same scheme. If you grow your book, those losses won't really hurt you, but eventually if you can't increase sales anymore and you underwrote all those car sales at a loss, it might hit you. Now, I'm not saying this might happen with BMW, but I think it's just something that I would be aware of if I invested in car companies today. Volkswagen, right now, they're extremely aggressive in Germany, selling cars at extremely low leasing rates. And again, it might hurt you at a later point. Then I looked at, I spent some time looking at real estate developers. And if you look at real estate developers, often I looked in the UK in 2008, there were tons of them. I looked in Europe, I even looked in India. And often there are two types of pitfalls. So one is the land banks. Often they have land banks, strategic operational land banks. And you need to look where they value those land banks. It can be that from a book value, they're trading a half book, you think, well, it's great, but most of actually the book value is a land bank that in reality has no value. I think David Einhorn, he made a great case in one of these situations. And then there's another risk. It's modern accountancy standards. If you have an asset-heavy business and you're able to appreciate the assets every year based on some random valuation that you come up with, you might be able to report earnings, but they're fake earnings, right? So looking at the cash flow statement might help. There's a company in Germany called GAGFA, it's owned by Fortress, and for a long time they posted profits, but the cash flow statement was a bit odd, let me put it this way. And I think right now they're selling assets at a loss, and the proceeds from those sales are not going necessarily into deleveraging, but they're also going to the shareholders as buybacks or dividends. It's been a while since I looked at the company, and I'm not saying There might be something odd there, but dangerous. But I think it's just something that you need to be aware of. Like, what is the quality of the earnings, and who's getting the cash from asset sales, and so on. Definitely something I would look at. I looked at situations where I think the market actually helped create inflated valuations. So for a while, everyone was looking at EV/EBITDA and was financing stuff based on EV/EBITDA, not looking whether the industry was capital intensive or not. And so what happened is that you had a company like eBay that never took out a huge loan, but I mean, their EBITDA is their free cash flow, so it's tremendously profitable. And if you have a cable company, they have huge capex, so EBITDA minus capex is a lot lower than EBITDA, and the whole situation changes. Now, with cable companies, there was always the argument that it's gross capex, they're investing in triple play, in new products, and so on. But maybe this was only half of the truth. Maybe they are capital intensive. If you have a telecom operator in Italy and you always look at EBITDA, maybe eventually they will have to pay for new licenses or new towers or whatever, or their fixed costs actually go up. So those are risks, right, that you might miss. And then what happens is that for a long time you get cheap financing, everything's great. The shareholders are the ones that they benefit the most because they can just refinance, they pay out whatever huge dividends and so on. But eventually someone might get hurt. Again, I don't think it might happen in all cases, but asset-heavy businesses like cable, telecoms, and so on might run kind of the same risk of inflated valuations through cheap financing. In terms of consumer goods, there's also an interesting opportunity to inflate growth and earnings. If you are a consumer good company and you do a lot of pipeline filling, you sell stuff into the stores, you will be able to grow revenue and profits. The danger is that if the sell-out, so what the stores actually sell out to the customers, does not equal the sell-in, this will create obviously an issue in the long run. So short term, it's great. So as long as you can grow your distribution channels, you have more product, or you grow in different geographical regions, it's fine. But eventually, the sellouts doesn't match the sell-ins. That's a huge issue. And something that I missed initially. Often I just looked at like-for-like sales and just revenue, but I never really understood sell-in and sell-out for a long time. And then ultimately there are governments, right? I mean, if you look at the United States, Europe, England, Japan, as I said, you can't keep printing money forever. You can't run deficits all the time, and can't keep printing money all the time. So eventually it will hit you. And I guess it's our biggest fear or concern, what will happen once the government financing environment will change.